We are in the thick of it now. Earnings season's off to a strong start with nearly 170 S&P 500 companies already out with their results, most of them beating the street's estimates, but we've also seen some huge, even outsized moves. Twitter, for instance, plunging over 20% today on an earnings miss, while Tesla soared nearly 17%. So how should investors play these big, potentially risky movers? Todd Gordon, founder of TradingAnalysis.com, is over at the Plasma to chart it out. Hey, Todd.
Hey, Melissa, yeah, isn't it unbelievable, like what kind of alternate universe we live in with Twitter down and Tesla up 17 or 18%. But we've seen a lot of sort of reversals within these ranges that are driving the overall markets. I think we're seeing a lot of oversized reactions to your point, Melissa, but it's in the context of a very range-bound environment. And to kick it off, I mean, look at Tesla. It's just unbelievable range here. 400 on the top side, 200 was the site of a lot of nasty short sellers who got squeezed, well contained. This is the weekly chart, and then you get down to the daily. I mean, obviously a big move up here. If you were a shareholder in Tesla, what do you do with this? I personally am not holding it, but what I would caution is a market typically likes to close the gap. And there was such a big unexpected gap, a lot of good news in Tesla, that I think a lot of people were caught on the long side of the trade. So if you were to see a little bit of a gap closure, that's not out of the realm of expectation. So I don't want to clear it to go to the next chart. I just want to get the circle out. If we do go back and do a 265 gap close, I would say don't panic on that. It's very natural. You'd want to see that hold. And then how high could we go? I don't know, potentially 400. You know, Tesla haters would say you're crazy with the fundamentals, but remember, it's always darkest before dawn. So from a chart following point of view, watch the upper end of the range. The other one, unbelievable, Twitter. I am a shareholder in Twitter. I don't like the action here. We've broken a very key uptrend support here. The line in the sand for me on Twitter is going to be these old lows. If we get below 26.5 in Twitter, I'm going to have to cut the position. The premise is wrong and just get out. But I just keep in mind that, you know, the overall kind of reaction is overblown within a very big range here. And I think once we get range resumption, then you could be a little bit more of a trend follower. So don't overreact here.
Question on Tesla, Todd. Where'd you get that 400 number?
Just the upper end of the range over the last couple of years.
Okay.
Just the upper end, yeah.
All right. And what will make you more convinced that it would reach that 265 and hold, and then next stop 400?
I'm not going to project that we're going to break to the upside again. If the underlying fundamentals continue to improve, I think we overreacted a little bit because we had some good news out of China. The onboarding of the China Gigafactory, anything related to China with good news, I think was kind of bought with a lot of enthusiasm. So maybe we get up towards 3.25. I don't know. I think there's a lot of short interest. It was nasty trying to break down through 200, watching those shorts cover. The new longs come in, momentum traders get in. So I think we're still in the process of covering that short with such a compelling, weak fundamental story. So the trend is your friend. I'm not going to put an upside target on it.
Let's say you're short and you're still short. What would you do here, Todd? I'm just asking for a friend named Tim.
Hi there.
I don't know. What do you do? I mean, put a stop, define your risk. You always get into a trade, maybe not so much an investment, but you always get into a trade, especially a name as volatile as Tesla, with a plan. At what point, what percent of your portfolio you're risking on this? That should have been decided before you get into a name like Tesla. Tim's a professional. I'm sure he has a stop on there. So, Tim, what's your stop?
Sorry, on Tesla?
What's your stop?
320, 325. But you know, the bigger point for me is the fundamentals around this story. Yeah. I want to see quarter over quarter how we went with essentially the same sales profile and completely changed the cash flow profile. And I think the company, to their credit, has done a great job of pulling forward revenue, of pushing off on a lot of expenses. There's $6 billion in payables and off-balance sheet liabilities. There's a lot of issues, I think, on demand. There's nothing about the fundamental story to me that changed quarter over quarter, or that I would suddenly say, oh, wow, they figured this out. I don't think they figured out anything. I think they figured out how to play with accounting. Those numbers, let's call them fine and accurate. But I do think that there's a lot of ability to take in deferred revenue and to actually decide where you can actually start to record some of the liabilities. So it doesn't change anything. Todd's right. You need to define risk with a name like this for sure. If anything, I think from an options perspective, I think over the next couple months, there's two ways to play it. I think you play it for a 2-month play into somewhere where I think all of the good news of yesterday, we will slowly get more details on the balance sheet. And I think you can actually, obviously, buy downside vol at a relatively cheap level to where you were yesterday.
Melissa, can I push my luck on the last caller?
Last quick word.
Twitter, overreaction pushed XLC down. I think those options look pretty good. We've got 8 more companies, top 10 out of holding XLC. I think there's a lot of good stuff coming in those communications. I think Twitter creates an opportunity, and it's sector spider XLC. Watch that.
All right, Todd, thank you. Good to see you, Todd Gordon, tradinganalysis.com. Let's get Twitter reported this morning, so this is our first take here on Twitter. Guy?
I'm disappointed for many reasons, not least of which the fact that they used July and August seasonality as an excuse. I mean, seasonality by definition it's season.
Right,
so, I mean, it's a little, but maybe it was worse than it typically is. What do I know? But July and August are historically pretty lousy. They shouldn't have used that, in my opinion. It is now round trip back to where we were. Remember when they changed their metrics? They went from getting away from active users. Stock traded down to 29.5. It was off to the races ever since. I think you buy it again here. Granted, I never thought we'd see these levels ever again, but here we are. I think you got to take a shot.
This is the most inopportune time for Twitter to have issues with their advertising platform. Engagement should remain elevated all the way through the election next year, and it looks like these issues with their advertising platform is going to continue all the way through 2020, so big issue for them.
Does Google or Facebook benefit from this?
I don't
problem?
know. I'm concerned. I don't know if they also are having the same problem. My
Right.
hope and guess is not, but I don't love that part of it.